morning, everyone. My name's John Holland. I'm with Paragon. We're a new disruptor in the trust space for trust design software. If you're an LBM that manufactures components, or even if you're one that subs them out, we are here to help you save money and rethink your process of how you buy trusses and resell trusses. I'm here today to introduce our next speakers. This next session is titled Smart Buying, Southern Yellow Pine Futures. With lumber markets moving fast, dealers need clearer pricing signals and better tools to protect margins. Today's session delivers both. In Smart Buying, Southern Yellow Pine Futures, Mike Wisnefski and Westline Capital Strategies and Allison Coughlin of CME Group will introduce the new Southern Yellow Pine Lumber Futures contract and explain why it matters to LBM dealers. They'll break down how it differs from the legacy Softwood Lumber contract in familiar terms, show real-world examples of buying physical wood through the futures market, and demonstrate how to use available pricing data to quote jobs with confidence. You'll leave this session with a sharper view of price transparency and practical ways to manage and control lumber costs for future businesses. Please join me in welcoming Mike Wisnefski and Allison Coughlin.
Hi, everybody. That was hopefully not an overpromise. Honestly, my goal is to not bore you to tears for the next 30 minutes. And you're gonna have to give me a little bit of grace here because I've been at the exchange for 12 years and I'm still learning about futures. And my job is to teach you futures in 10 to 15 minutes. So we are not going to get into a ton of details. I'll leave some of that to Mike. But we're gonna cover a little bit of the basics, what futures are, why they exist. This is the part of the presentation where I tell people that I became an economist so I could be wrong like half the time and still have a job, and that's only a little bit of a joke. Please do not take trading advice from me. None of this is meant to tell you how to run your businesses. You are all experts in that. I'm only here to give you a Futures 101, and don't take any of this as advice as to how to structure your hedging strategies. So I hate to be the next in a line of speakers to ask you to raise your hands, but can you raise your hand if you watch the futures price or if you look at the price of our SPF or SYP contract at all? Who here trades futures? Okay, and who here has absolutely no idea what I'm talking about at all whatsoever? Okay, a few hands. So futures seems really complex, but really futures are a contract. It is a contract between a buyer and a seller. The only thing different about futures contracts versus cash contracts or physical contracts is that CME Group, the exchange, sets the terms of futures contracts. It is a standardized, I've highlighted that word a few times here, a standardized contract. And that is just so everyone can speak the same language. So it is a standardized asset in terms of Southern Yellow Pine. It is the value of 1 truckload of number 2 2x4 Southern Yellow Pine. It is at a standardized place. In this case, it is the Random Lengths East Side assessment and a standardized time. We list futures every other month and they expire middle of the month. So instead of cash contracts that say, I need 2x6s and I want it in Georgia and I need it in over the next 60 days. The futures contracts are just standardized language so everyone can speak in terms of futures contracts, and there's not enough liquidity to list derivatives or futures contracts on every single line item, for example, that Random Lengths reports on, or every dimensional lumber that exists out there. A lot of these are highly correlated, so CME is in the business of trying to find the most liquid or the most highly correlated assets and listing futures on them so the market can trade them. These are, as I was saying, the standardized terms. We have these for every contract that we offer. So we have them on our SPF contract, that's our legacy lumber contract, and on our Southern Yellow Pine contract, which we just launched this year. And I don't want to spend too much time on this, but this is what our trading platform looks like. For those of you who did raise your hand when you said you traded futures, your front end might look a little bit different. This is just our platform that we offer to the marketplace. And I want to highlight this because one of the questions I'm asked most often is, how does CME come up with the price of lumber? CME absolutely does not come up with the price of lumber. I am legally not allowed to forecast, yet another reason you should not take trading advice from me, but we are merely the platform to allow buyers and sellers to come together. So CME stands in the middle. We are technically the buyer to every seller and the seller to every buyer, which means that we're guaranteeing the trade. There's no risk of counterparty default. But we provide the platform. You can see this top line is our SYP contract. There are 6 trucks that someone or multiple people want to buy at $393, and 6 trucks that someone or multiple entities want to sell at $397. Those are real prices, real bids and offers out there in the market that you can transact with. So let's say you are needing to protect against the price of lumber going up in the cash market, and you want to buy a futures contract to protect against that, which we'll get into. You say $397 sounds fair. I'm going to buy one futures contract at $397. What does that mean? Every single day, we settle our contracts using the traded prices from that day. Again, CME is not setting the prices. We are not estimating where the price is going to be. Every day we say, this is the price. Usually it's a 1-minute volume-weighted average window. Sometimes it's the last trade price, but there is a very strict methodology that we follow, and it's public, for what that daily settlement price is. All that means is that's where the value of your position is today. So if you bought at $397 and the daily settlement price is $400, you are up $3 per 1,000 board feet in your account. You do have to post a nominal amount of money. It's called margin. Essentially, that guarantees that once the contract expires or you exit your position, you have the money to give to your counterparty or have an account to receive the money if you are in the green or have a positive balance. You have this one futures contract at $397. Every day we're settling that. What can you do with this contract? There are really 4 things you can do. 1, you can sell back a futures contract. Now you're out of the market. You're net zero. So you bought one, you sold one, you're out. You can roll that contract to the next month. Let's say you have a cash contract and you're set to build homes and that gets delayed. So you can roll that position to the next month. You sell out of your current position and take a position in the next month. The third thing you can do is what we call exchange for physical. So Southern Yellow Pine futures are cash settled. Our SPF futures are physically delivered, but the way that our markets interact with cash markets is partly through this exchange for physical process. You are long, you bought one futures contract. If you find a counterparty that will sell you the physical lumber, you go to the exchange and you say, I'm returning my one futures contract in exchange for this physical lumber. Now you're out of your position. Or the 4th thing, you can hold it through to expiry, which basically just means that at the end of the contract life cycle, which is the 16th day of the month at which it expires, cash goes into or out of your account. The way we come up with that final settlement price is taking that Random Lengths SYP East Side assessment every day from the 1st of the month, so the next expiry month is November, so every day from November 1st to November 15th, we're taking those prices, we're averaging them, and that becomes the final settlement. So if you bought at $397 and the final settlement is $405, you now are credited, your account is credited $8 per 1,000 board feet. Obviously, the futures market can go against you, which we'll also get to. Thanks to Mike, here's one example. He built this great spreadsheet showing here are the daily assessments that Random Lengths had put out on East Side Southern Yellow Pine, and that green shows what the final settlement price is. Honestly, it is very simple. It is a simple average of every price that comes out during that time frame, and Random Lengths actually gives this information out for free. So you can sign up for their daily newsletter. It's on our website, or if you go to the Fast Markets Random Lengths website, you will get this, this print every single day. So you can follow along, you can ascertain how it relates to your business. Obviously, if you're not you don't transact in the east side, you're gonna have some basis risk, meaning your cash prices are different from the futures prices on the screen. Really important to understand the relationship between the price that you're seeing in the market and the futures price. So as I said, I am absolutely not here to tell you how to run your business, but I do want to highlight two things that futures generally help with. You know, why do they exist? Why does this matter to me? The first sort of purpose of futures is price discovery. This benefit is conferred upon every single person in this room. You do not have to trade futures. You do not have to have a position. You can go on the CME Group website, and all of our settlement prices are public. So not only can you see the price where the market is valuing Southern Yellow Pine today, you can see where the market is valuing Southern Yellow Pine in the future. So you can see the November settlement price, the January settlement price, the March settlement price. That is allowing you to make decisions today based on where the market is forecasting price in the future. If it costs you, I'm throwing out random numbers, if it costs you $5 per 1,000 board feet to store lumber in your yard, and the market is telling you that if you wait a couple of months, it's gonna be worth $25 more, that's a signal to you that the market is well supplied, and you are going to get paid to hold on to your physical lumber and sell it at a later date. So this just shows the forward curve. This is a normal forward curve. Usually the deferred month futures price is higher than the current futures price because it costs money to store commodities. Sometimes a later month is actually priced lower than the current month. That is a signal to the market that we are undersupplied, and you should be selling your lumber today, because if you hold on to it, you're paying storage and you're getting a lower price for it. So like I said, you don't have to have a position to understand this. All of this information is free to you. You can go onto our website and see where the market is pricing lumber today and in the future. The second, and more important in my opinion, because knowing the prices only does you so much good, is you can manage your price risk. So if you are a mill, your risk is that prices go down and you can sell your product for less money. If you're a home builder, you're worried that prices are gonna go up and you're going to be paying more for your physical lumber. If you're a wholesaler, you actually have price risk on both sides. You have a risk that you're gonna pay a lot for the lumber, it's gonna sit there, prices are gonna go down, and you're gonna sell it for a lower price. So because futures and cash move together and are highly correlated, you can effectively use the futures market to lock in prices. This is just an example where if you are buying futures, you need the physical lumber and you're concerned that the price is gonna go up and you're gonna have to pay more in the cash market. If you take a long futures position, you end up with a $42.50 gain. You have lost money in the cash market. If you wanted to buy it at $430 and you're now buying it at $480, you're paying $50 more. By taking that futures position, you have offset that loss. Instead of a $50 loss, you have a $7.50 loss. The market, because you are not selling only number 2, 2x4, east side Southern Yellow Pine, the markets are not going to 100% reflect your price, which is why it's important to understand your price relationship relative to futures, which is something that someone like Mike can help with. The opposite of this can also be true. I often hear, if I didn't take a position in the futures market, I would have made money in cash and I wouldn't have lost money in the futures market. Absolutely fair. Hedging is not a way for you to make money on the cash side and on the futures side. It is a way to lock in your margin, and plenty of profitable companies. You may have heard of a small company called Cargill. They're one of the most successful in terms of revenue private companies in the world. They hedge all of their commodities. Not a kernel of corn goes through their system without hedging it. And they do that to lock in their margins on those products so they can take risks in other parts of the business. So if there's one thing that I can leave you with, it is this. It's my favorite saying. People have this perception that taking positions in the futures market is like gambling or it's really risky. And I always say, if you are touching the physical product, the physical commodity, and you're not hedging, you're speculating. You are open, you're naked to the physical market going in directions that you don't want it to go. And so that's why the futures market is here to allow you to lock in those margins and forecast what your future is going to look like. With that, I'm going to hand it over to Mike.
Thank you. Oh, you can put up my presentation, actually. So everybody here knows southern yellow pine is hard to inventory. It is really hard to keep southern yellow pine in your inventory for 6 months, 12 months, and it's expensive. Now, futures doesn't matter to anyone in this room if you have business for 1 month out. Like if your customers all buy 1 month out, no problem, just buy the wood directly from the mill, it rolls in, that's great. But if you have customers that want wood for 6 months out or want a quote for 6 months out, now you've got a problem. So this is the reason you should care about futures. This is going back to 1995, what Random Lengths said the price was on 2x4 number 2 southern yellow pine east side. This next chart, this is the same chart, it's just squeezing the time frame down. This is a 10-year chart. This is a 2.5-year chart. So one of the things you see on that is those charts kind of look like an EKG. This market moves around. What that means is it is volatile. And we can actually measure this volatility. So now we're going to get a little nerdy here. This is a measurement of the volatility of that price chart. It's a simple calculation. And if you notice the bar or the prices, they're not prices, the percentages on the left side of that chart, that is the percentage in kind of layman's terms. It's the percentage that you can expect that price to move over the course of 1 year. So now we're going to, once again, pull it in. This is a 10-year average. And the thing to look at here, starting back, in the 90s until basically, 2015, 20% was a high volatility. 10% was kind of the low volatility. So now we all know what happened in COVID. I don't have to tell anybody about that. But do you see the slight upward drift of this chart? Now let's take a look at, this is the last 2.5 years. All of a sudden, 20% is not the high volatility anymore. It's the low volatility. So volatility of pricing is picking up. And this is just so the other charts were a 25-week rolling average, annualized, which basically just means it's a smoother way to look at what the prices are going to do over the course of a year. This is important. 20% annual volatility, this isn't theoretical. Granted, I calculated these prices, but this is your everyday risk. Risk is a word that has no emotion. Risk can mean good things, it can mean bad things. The only thing risk means is that something's going to change. Your relationship with risk is what starts to put emotion into the situation. So, hopefully, after seeing all of that, you're thinking right now, well, yeah, okay, I already knew that. Like, lumber prices move around. So, what can you do about lumber prices moving around and operating your business? I'm going to just go through 4 quick things. Hedging, something that Allison talked about. You have wood on the ground, you get nervous about the prices going lower, you can hedge it, you can protect it. Basis trading, this is a great one, and it's so underutilized by this segment of the industry. This is where you are able to capitalize on opportunities of price discrepancies, differences in prices that are out of line. Forward selling. If we're going to touch on this one, this is great. And then speculation, I love it. That's what I do every day. We're going to hit that. So first off, we're going to go through hedging. How do you hedge? Number one, you got to know what you have on the ground. You have to know, how does the wood you have on the ground fit into where the current market is? You have to have a multi-view strategy, meaning you can't just be myopic and look at it from I'm a lumberyard, I'm sitting here with this wood on the ground. You have to think about hedging from, I'm this lumberyard, but I've got these forward sales, but then do I want to have more inventory from a speculative standpoint? Like, you have to be dynamic in the way you think about it. Monitor market conditions, and in the end, after you've done all this, you make a decision, you can buy or sell futures. Basis trading. I'm going to go through these quick. So all you're doing, you analyze the market for an opportunity. If you see something that is undervalued, that's cheap, you buy what's cheap, then you sell what's expensive. If you see wood is cheap, futures are expensive, that's basically what you do. You buy the wood, sell the futures. Had you done that this year, and I hate to only bring up a good thing, but this year, you could have made $5,000 on a one truckload of wood if you bought it January 1st and hedged it, and then moved your hedge all through the year. $5,000, one truckload. If you have 100 trucks, you made $500,000 just for being in business and being able to hedge and sell wood. Okay, forward selling. Think about this, no one has to raise their hand. How do you go out and price business that's going to deliver in 6 months today? So far I've been asking people this, they don't really have an answer. They just kind of put a price on it. So forward selling is, you find the job, you look at what the futures curve is doing. The futures curve is, what are the extended months? Like today we're in November or October. What is the March contract pricing things at? You set your selling price based off of where you could actually buy wood today for shipment in March. It's very hard to call up your distributor and say, hey, I need to buy a truck for March 15th. What's your price today? They generally aren't going to give you a price, at least not on that first phone call. But you can know what your price is by looking at the futures markets. You can sell to your customers with confidence that you can cover that job. And you buy futures to lock in. But the most important thing here is check the futures markets. Know what your true cost today can be for a truck that will deliver in March, in May. Speculation. This is what, generally speaking, the industry does day in and day out, yet they think the futures is gambling. It's quite the dichotomy. When you're going to speculate, you need to define your risk parameters. You need to build a strategy. You monitor the market conditions for opportunities. You initiate the buy-sell. And then you exit the futures according to your strategy. This is kind of investing 101, but I would encourage you to utilize this same kind of steps in buying cash lumber and operating your business. Okay. This is probably the most important slide to think about. You have to know your business. And by that, I mean you have to have a deep dive into, what's my forward sold book? How much wood do I have on the ground? What wood do I have on the ground? Do I have expensive wood? Do I have cheap wood? Like, get in and know your business. And I'm really excited about what they talked about with AI earlier. AI is going to give you an excellent opportunity to get deep into the weeds of your business. Know the market. You should know what every month is doing and how it applies to your business. So yeah, you're understanding the product mix and the delivery, performing the deep analysis. The bottom part here, don't go alone. Too many people rely on one individual to kind of manage their lumber exposure. You should have a team. You should have an outside expert as well. And on your team, how many people here have the salespeople and the procurement, the buyer, sit down and talk? I mean, why would you not do that? Why would you not have your sales guy know exactly where the buyer's buying? Why would you not have your buyer know where the sales guy's selling? So get your team together. You get your CFO involved. Have them sit down, help with the calculations. Get the whole team together, and or the logistics people. There's opportunities with just logistics. If you get the team to sit down and do some strategy planning, you'll be much better off. Okay. We all know what we know. And then we know what we don't know. It's what you don't know that's going to get you. And I don't think it's fair that people will say, well, hey, I won or lost on this business decision. So let's say I have this big inventory. I decided to hedge. The market goes ripping higher, and we lose money on futures. We make some money on the cash. But with the information that you didn't know when you made the decision, you start to judge that decision. Meaning, time goes by, something happens, COVID happens, interest rates change, tariffs happen. It's not fair that you judge a business decision at a moment in time without all the information. Lastly, if you could pull up this is the actual live market, and I apologize, there's a lot of stuff going on this, but two things to look at. The bottom of the screen, the numbers that are flashing, that's the stock market, and it's a very active market. Lumber is up and down the top, but the futures market is deep and liquid, meaning if you look at this column right here, this is the volume. So far today, in the spruce contract, they have traded almost 700 trucks of lumber. That's relevant. 700 trucks of lumber, all priced based on Chicago, is relevant. The southern yellow pine market has traded about 25 trucks. It's coming around. And I'm going to open this up a little bit. This is just the November contract for the spruce, the legacy contract. These are all bids. So from $626.50, there are, what is that? I should put my glasses on, would help. There's over 20 trucks that you can buy within $2.50. On the sell, that people you could sell, I should say. On the sell side, once again, there's probably like 30 trucks you can buy from $630 to $632. So I want to just wrap up. If this is confusing, which it probably is, the reality is it's easier than you think. It takes a little bit of studying, but it's easier than you think. I highly encourage you to come to the roundtables tomorrow. I'll be there. Unfortunately, Allison won't, but I can walk through examples with you and let you know how much easier it is. Most important with this information is to be proactive. Being reactive is just you're letting the market do to you what it wants to. If you're proactive and you have a plan and you use this data to do pricing, use it to sell, you will differentiate yourself from your competition. I see it all day long. People don't use this information in selling, and it will give you a leg up. Mostly I just want to say is, buyers have an unrealistic confidence in their ability to forecast. I've talked to a couple people here, and they talk about their buyer kind of in that same way. I've traded lumber since 1995. I make a living trading lumber. I pay my mortgage with it. Here's what I know. I can see out about 30 days. 6 months from now, I have no clue. What's going to happen in the next 6 months? Here's a better one. Who's going to win the World Series? We're down to 4 teams. We don't know. Who's going to win the Super Bowl? You don't know. There's so much that's going to happen between now and then. If you don't respect time and what can happen, You are speculating, like Allison said. Not utilizing a valuable tool like this is pure speculation. Thank you.